Welcome and thank you for joining today's 504 Connect call. Please note that all participant lines will be muted until the Q&A portion of the call. We will provide you with instructions on how to ask a verbal question at that time. You are welcome to submit written questions during the presentation, and these will be addressed during Q&A. To send a note, select All Panelists on the Send To drop-down menu of the chat panel located on the lower right-hand side of your screen. If you are experiencing any issues joining the web session via the downloaded plugin, please go back to the Add WebEx extension page and use the Run a Temporary Application link at the bottom of the page. If you require technical assistance, send a note to the event producer or call our help desk at 888-796-6118. With that, I'll turn the call over to Diana Seaborn, the Director of the Office of Financial Assistance. Please go ahead.
Good afternoon, everyone. Thanks for joining the call. Thanks to our third-party lenders, our CDCs, CA lenders, insiders at SBA and all. I am acting my role today on the stage is Bill Manger. I'll have to gruffen up my voice, but I still have red hair like Bill, so we're close enough. So let's get started. We're just going to chat a little bit about the stats, which you all have a copy of, so I'm not going to read these slides, but if you'll go to slide 4, let's just take a look at where we are on 504 activity. Slide 4, please. Here we go. So we have year-over-year activity, as always, for our 504 program, and you can see that the 6-year period, year-over-year, we've kind of bumped up and then bumped down, and we are out of the chute this year, lower than we were last year. We are looking at the issues, and we'll talk a little bit more about that later in the conversation, but just so that you can see our activity, we're at 1,805 loans as of January 31st. And then we need to go to slide number 8. So for those of you who are also micro-lenders and or Community Advantage participants for our CDCs, you can see the numbers for Community Advantage are stable year over year, although our dollars are up. So we're still getting traction, and the trajectory is upward generally for the Community Advantage program. And I would say that a good bit of that comes at the hands of our CDCs, who are not only doing the 504 loan program, but are offering these smaller loans on a mission-based agenda for some of the loans, some of the businesses that are getting loans through the 504 program and need other support and or other small companies. So we're continuing to see that program grow. Microlending is up year over year, and another place where we've put a lot of emphasis and activity, and you can see that we are up 2018 over 2017. So the rest of the statistics in here show our overall performance in terms of activity, sliced and diced by 7A delivery program, veteran women, minorities, and others. And so you can read those at your leisure, and we'll just move on to the conversation about 504. So I guess we're now on slide 13. How's that for brevity, everybody? So what's happened to us in the last quarter? We issued the SOP, which is the origination for both our lending programs, the 5010-5J version, in January of 2018. Obviously, we released it with a lot of fanfare around a couple of topics that both lenders and CDCs have indicated we need to revisit: credit elsewhere, special purpose properties and equity requirements, and insurance guidance. And I'll let Linda drive down to more details on that in just a moment. But, you know, basically the issue on 5010-5J largely has been the inclusion of a requirement to test the liquidity of 10% or more owners. And we are working on a notice that is currently in clearance that will bring that back into a situation where we are looking more at the 20% and over ownership, not dissimilar to the former personal resource test. So stay tuned. We hope to have that cleared and have some additional guidance that makes it a little less onerous in terms of collecting additional paperwork and reviewing additional by the end of March, the beginning of April. Our 25-year debenture product is still rolling along. Again, I'll let Linda fill you in on those details since this is her baby. We are still expecting to be able to start taking loan applications for 25 years in that program by the end of April. April 30th is our target date. The 504 debt refi final rule is in clearance. It is largely unchanged from the interim final. It's got a few tweaks in it. We expect to have it also delivered during the month of March so that it has a permanent final rule as opposed to an interim final rule, which has been in the reg now for over a year. HBCRE comments. SBA has provided comments to the federal regulators with regard to our position on requesting an exemption for 7A and 504 in the classification of HBCRE, which now has a different acronym, and I can't remember what it is. But it's no longer HBCRE. It's something different. New forms, and I should not say new forms, really updated forms for 1244 and 2450. Linda will walk you through the changes and the timing on those. One of the things that we need to tell you all, third-party lenders, CDCs, and everyone on the phone, is that we are having some challenges, as you probably already know, with our website and getting things posted for current documents. And we are in the process of making everything that we have outwardly facing 508 compliant, which means it has to be usable by someone who has no vision, so it has to be a readable document. And we don't have enough resources to get them done overnight, so we are working on making that happen, and we're asking for your patience in looking for updates on the SOP, updates on forms. We have provided both NADCO and NAGLE, for those of you who do CA loans, with the current forms. They are, in fact, in force and should be used as opposed to former versions, and the only challenge we're having right now is getting them into the public website in a 508 compliant form. So the forms that NADCO and or NAGLE have distributed very recently are the current forms for the application of the 504, the 1244, and for 7A, it's the 1919 and 1920. So be comforted in that they have them, and what they're providing to you is the current version. We appreciate your patience as we get, the web content compliant so that everything that we have will be outwardly focused as well. One of the other locations or sources you have to pick up that information too is from your field offices. We have provided the field offices with all of the current documents, and they too may be called upon to provide additional support in current documents. One of the things that we've been working on with regard to the 504 program, and many of you already know this, I know some of you are on the board, is we have met several times within the last 30 to 45 days with NADCO on the list of ideas that we've received in comment formally from those of you who provided comment. We appreciate that. The administrator and the executive team here at SBA has gone through a large book of comments about deregulatory recommendations and general suggestions, and we want you to know that we're working through them, and we know that we move at a snail's pace, but we have a lot of good suggestions. We have had good meetings with NADCO over the last 6 weeks, and we have identified specific areas where we think that we can work together this year to bring improvement to the process for 504, of applying and or closing 504 loans, and looking at some deregulatory actions for corporate governance that will remove some of the costs for our CDCs and make it easier for third-party lenders to get in and process those loans as quickly in the 504 program as they may in the preferred program for 7A. So we're very thankful for all the input you provided. We're very thankful that NADCO has identified specific resources to work with us in looking at improvements such as closing attorneys on your end are providing us with insights and suggestions and recommendations to consider on closing 504 loans, et cetera. We're very sensitive to the fact that our volume is not where we'd like it to be this year, and we want to do everything we can to stimulate that as quickly as we possibly can. So I think that's all I have to say, both acting as Bill and as Diana, and I'm going to turn it over. Of course, I'll be around for questions towards the end. If anybody has questions or comments, we always welcome them towards the end of the narrative discussion, I guess, here. But I'm going to welcome, from Steve Kacharski's team in OPSM, Sherry McConville will walk you through some updates on what's going on with our data team.
Thank you, Diana. Hi, everybody. I just want to talk a little bit about what's been going on with the modernization. In the last few months, we've really rolled out a lot of things. The first thing we rolled out was CDC Online. We did that a couple months ago. We took that out of the Wells Fargo system and moved it into our CAV system. We also moved the FMLP loan program. Those loans that were there, we moved that out of Wells Fargo and moved that over into CAVs. And then finally, I guess a week and a half ago, we moved the CSA mainframe, which was the guts behind all the closing, out of Wells and into our environment here. We did our first funding. All of the loans that were scheduled to be funded, they all got through. There were a couple of things that we had to jump in and fix, and we've worked on those. And so we expect that the next funding will be much smoother, but this one we got through it. We appreciate all the help that we got from the CSA. I know the CDCs were a little confused at times, and they were able to reach out to Wells Fargo, and they spent a lot of time on the phone with you folks, walking you through how you had to do some stuff. We're going to offer some additional trainings on how you will go into E-Tran to make changes to these loans before they close finally, and we're working with ventures to make sure that we can assist them in being able to call us and get all those updates in. So we're really excited about this. Now that we've got everything into the CAVS environment, we can start looking at some enhancements that'll make the process a lot more seamless and get these deals done in a more timely fashion. So that's really all I have.
So let me just ask a couple questions, because I probably know less than even our lenders on the phone about some of the things. The migration from the CSA to our mainframe environment, now that it's completed, will it eliminate some of the challenges we've had in the last couple of years about when things go down and they're not able to enter a process? Does it resolve those issues by bringing it in-house?
Okay, bringing it in-house, what we did was just really what's called a lift and shift. We didn't make any changes to the existing processes except for a few. There was a lot of emails that went back and forth. Let's say that the address was wrong or the ACH information needed to be entered. Before, the CDC would send paper to Wells Fargo, and then a Wells Fargo agent would go in and update that. Now these fields are all in E-Tran. The CDCs already all have access to E-Tran because that's where they're originating the deal. The loans that we had problems with on this last closing were actually older loans because these deals take so long. These loans were originally done at the SLPC where they had minimal data. The data in E-Tran now is the full set of data. So once we get rid of all those older loans, we won't have as many problems. But we're working to try to find the source of this data so that the pain points will be less than they have been. But it should eliminate a lot of, okay, I have to send this and now somebody else has to enter. The CDC is the one that's got the information.
Sure.
You know, why should they have to go through somebody else to get that information in there? And again, we're working, if you use Ventures as your product and you're already entered the information in Ventures and SBA are working together so that information will flow in through E-Tran. Okay. But until such time as that, you can use, the web screens are always available. And if you're not using Ventures, the web screens are there. But we're trying to get the data into E-Tran without as few touches as possible.
Right. So it eliminates more stops along the process,
right,
to getting these changes done, to getting you closer to closing more quickly.
Right.
So that's good.
Another thing that we're working on is we're going to show the status of the loan when it's at the SLPC.
Oh, that's great.
So right now, you enter your loan in E-Tran, and it goes into Reviewer 1S, and it's at the SLPC. Now, you get emails through the SLPC's process that says what it is, but maybe your email's down, or you're not getting emails for whatever reason.
Right.
You can go into E-Tran, and you'll be able to look and see that this is the status at the SLPC.
So for third-party lenders on the phone, what they know now is that your CDC can look into the system and see where the loan is in processing at Sacramento Processing Center. So that's something that, for the third-party lenders on the phone, is probably pretty meaningful, because they now know, in real time, where is this in the process.
Correct. And then as to the third-party lenders, there's another item that hasn't been started yet, but it's just in the planning phases, where we're looking at a way for the third-party lenders to be able to come into CAB and see directly what's going on with their deals.
Okay.
So we're looking, now that it's all in CABs and all the data is in one place, we're able to leverage this and be able to give as much value as possible to all of our different partners.
So that's
we're pretty excited about that.
Yeah, that's good news for us.
Now, Sherry, one thing that you brought up was that some of the changes the CDCs can actually go into the system and do. Now, these changes only affect Wells Fargo, correct? Not the 327, like, for instance, if they have the incorrect name for the borrower, or if they have the incorrect address. Do they still have to submit those documents to SLPC?
No. There was guidance that was given out that there are certain fields that they have unilateral authority to be able to make, so they don't have to send the 327 action. So they go directly into E-Tran to change the name of the borrower, to change the address, to enter the ACH information. It's only those things that they can't go in and change the interest rate or the maturity, or there are things that they don't have the unilateral authority
just for the
do.
unilateral. Perfect. Okay.
Right.
And have we provided that list to the industry of what they're unilateral?
The notice was sent out a while ago.
We provided a notice for PDCs that are on the line, and if you don't have it, you can reach out to NADCO or to Linda's team, and they'll resend or point you in the direction on where you can find that notice so that you know what actions you can take unilaterally. Again, that's one of those time-saving things for your third-party lenders. It just cuts out some of the layers of review and the back and forth on it. And now, as Sherry said, that everything is migrated into the system internally, it gives them a lot more opportunities to identify further areas for transparency and improvements in terms of touches it and how many times we have to touch it. So that's good news so far, and more on the way.
Right, and you're only entering the data, because it's in one database, you're only entering the data once. So if you go in and you change the name of the operating company, it's changed everywhere. If you change the address, it's changed everywhere, whereas before you had these two disparate systems. So.
And for third-party lenders, you may be chuckling at us for thinking that that's sort of like groundbreaking stuff. Well, for us it is. We know you've been there for years, but we're trying to catch up. So it's pretty exciting for us. It's pretty exciting for our TDCs who've had to use, a much more manual system. And we appreciate that it may not be state-of-the-art for you, but we're getting there. So thanks, Sherry.
Okay.
And Linda's going to step in now and do some details for these activities and things that are going on in the SOP with the debentures and the programs and things we've got going on for 504. So we'll let Linda step in, and then after that we'll take some questions.
Thanks, Diana. If we could go on to the next slide. There's someone else on the call I'd like to introduce as well. We have Hian Nguyen. He's the SLPC director, and on his team with him is David Miller. Here at headquarters with me is Babak Husani. And let me just explain, because we always have new participants on every call. The number keeps growing every quarter. It's exciting. So as I'm the policy chief, Babak works here at headquarters on reconsiderations and appeals, as well as on policy development and policy training. You know that he and his team run the loan processing center in Sacramento. David is the senior loan specialist who works with our team and who does quite a bit with many of you in the CDC world. So, Han, I'd like to give you a few moments, if you would, to just tell us what's been going on at the center, what are some exciting things that you're doing. I know that you've come in with a huge focus on customer service, on cutting out screen-outs, and on automating. I think Sherry's talked about a few of your automations that you've wanted. So is there anything else you'd like to add?
Well, thank you, Linda. Good afternoon, and thank you all very much for your participation in this call today. I believe these calls are very beneficial to both industry and the SBA alike, as they provide a good communication forum here for us to discuss currently hot topics such as policy and procedural changes, as well as what's going on at the center. These interactions will definitely strengthen our partnership in providing capital access to small business communities. Now, in speaking of the center, in the past few weeks, we have experienced a significant increase in loan servicing requests, and that has caused our turn time in handling these requests a little longer than usual. We're working through these heavy inventory as fast as we can, and we appreciate your understanding and patience. Linda mentioned about improving customer service. We continue to work on process improvements with the goal to increase more interactions with CDCs when deemed necessary. We have recently implemented a new processing procedure in which we ask the loan processing officers to allow the CDCs an opportunity to provide any additional needed information or documents for us before we officially decline the applications. In the past, we would, if we have sufficient information in there, we would make a decline recommendation and allow the CDC to come back with supporting documents to possibly overcome the decline decision. Now we'd like to increase that communication line by providing the CDC an opportunity at least to provide any information that they may have that was not originally submitted with the application for us before we make a recommendation, especially when we decline the application. However, we will continue to provide a summary screen out for applications that are not that are insignificantly complete or insufficiently represented. We will continue to do that so that we don't jeopardize the turning time for the CDCs to submit more complete applications. I hope that you will enjoy the presentations and discussions, and thank you.
And this is Diana. I've got a couple questions just to be clear on the opportunity to address issues that are outstanding before you actually issue a decline. Do you communicate that information by phone to the CDC, or are you sending emails to the CDC inviting them to provide additional information and telling them exactly what the challenges are in the package?
Well, it depends on the nature of the needed information. It's something that we can quickly obtain by pick up the phone and then contact the CDC. We would do that. If there's something that we don't think that can be provided as quickly as within hours or so, then we would have to provide a screen out asking for additional information.
Thank you.
You're welcome.
Is it the same process for 327s that are declined or that have incomplete information? How does the center correspond via those?
I'll let David answer that question.
Thank you, Babak. Good question. For servicing actions, if it's something real simple, we certainly can pick up the phone and give them a call. If the action is incomplete or the numbers don't add up, that's not really something that we can address over the telephone, because they're going to need to submit a corrected servicing action where the numbers do add up and all the pieces are there. So that would usually result in the decline of the action that came in with an explanation of what we need or what needs to be corrected for the future action.
Thank you.
So what I think the third-party lenders can hear on the call is that, you know, the CDCs and the centers put a lot of work into these files once they get them. So to the extent that everyone, and I know everyone is in a hurry and everyone's trying to get a deal done and trying to get it off the street, but the more complete information that the third-party lender can supply to the CDC and that the CDC can supply through their resources to the center, you know, the quicker the turn will be. If we're having some challenges in an increased volume in changes and challenges in what is issued through, we would be interested in hearing about patterns, if there's a concentration on area, if there's some confusion about something in the policy or a direction or applying the rules that's not clear. We would be very interested in hearing that at headquarters, so feel free to send in an email to Linda or anyone on Linda's team just saying, you know, this is what's going on. It's a concentration issue. We've had 4 of these circumstances in the last 3 weeks. We want to make sure that there's nothing that we're putting in the policy, or if there are areas in the policy where we can improve the delivery of the direction, we certainly want to do that. So feel free to inform us about the challenges with applying the rules in the context of getting a loan done.
Which is the perfect segue for our next slide, Marvin. Marvin, if you don't mind, let's go ahead and advance the slide to credit elsewhere, because that is probably the thing that has come up the most recently since the SOP came out. It actually started a little bit earlier, and we actually made a technical correction in the SOP. One of the things that has been pointed out to us is that although the personal resource test was removed, that when you're looking at credit elsewhere and you're asking to look at liquidity, it sort of still feels a little bit like the personal resource test, but we're trying to provide guidance to say that at this time, that's not our intent. But as Diana mentioned earlier in her introductory remarks, that when we did go from looking at 20% to 10% of ownership, that did get a lot of this feedback and pushback that we heard from our TPLs and from our Cs, and SBA has taken a fresh look at that. We have a notice and clearance. We don't have anything to announce today. We will have something to announce later in the month, but I would say we've heard you, and I think that you will like the notice when it comes out, but we can't give the details today. So what can we say today? What we would say today is that when the CDCs and lenders are documenting in their credit memorandum and in their files that the liquidity of the principals have been considered and that credit was not available elsewhere, and the personal financial statements were reviewed, and that credit was not available elsewhere, that by documenting that in the credit memorandum and retaining that in your file, we believe that you've done your due. So more detailed training is forthcoming on this issue as the notice is released. We know that Mid-America is coming up in April. I'm sure that we'll be doing other webinars with our trade partners, NAGLE and NADCO, soon. So, and also, too, we'll be having opportunities to get those notices out through our website and through NAGLE and NADCO and our other partners. So, next slide, Marvin. Another issue that came in abundance in questions is the equity injection for special purpose property. So while there were concerns that if you had a special purpose property having an additional 5% equity injection, but it was also a new business, what would that mean? So we were very clear in the SOP that we're not looking to have a larger equity injection than 20%. So we wanted to make sure that you're aware of that. And also, too, we do have the requirement that after the first special purpose property, there is an additional 5% equity injection. And where this hits most of our projects is when you're looking at a special purpose property that's also either a manufacturer or a energy public policy project, because those are generally the ones where you come back and you see multiple projects. One of the criticisms that I have heard is that, well, 7A doesn't have to do this, but also, too, 7A does not have the opportunity to go beyond the $5 million. So if we're asked to take larger and larger risks on the 504 side by the project cost and the project side, we are looking that the borrowers share with us in the risk, and after the first projects, then they would then put an additional 5% equity injection. So that's the explanation of why we're sure the dialogue will continue on this issue. And Diana may have a few things to add.
Now, I just have a question that's come up on the screen that lends itself to this discussion on special purpose properties. We have a question that says, how can we find out if a project is a normal building instead of a special purpose property? The SOP says the list is not all-inclusive, but does not elaborate.
Well, we do have the list for those that are the most frequent occurrences for the special purpose property, which have been fairly standard for the last 10 years or so. I would say that if you really have a doubt, although you don't have to provide the appraisal at time of application, you could coordinate with the appraiser that's going to be working on the project and ask them for their professional guidance. Is this the type of project that would normally be a special purpose property or not? So there are ways, not only historically with our SOPs, to look at the list that we do have, but you've got professionals in your community and within your third-party lenders staff many times who work on so many projects and who have so much knowledge in this area that they can give you the guidance of the strong likelihood that it will be special purpose before you get the appraisal report.
Thank you, Linda.
Oh, the credit elsewhere notice that we talked about, we don't have a specific day. As Dinah said, government doesn't always work on a specific timetable, but our goal is the end of the month. So I would say that is our goal, and certainly we would like to get the guidance out before, as soon as possible, but before Mid-America.
And it will come in the form of a notice, of an agency notice.
So next slide, please. I'd like to turn this section over to David Miller, although it is, on policy. This recommendation to us was provided by the Sacramento Loan Processing Center. NADCO came to us for specific guidance for CDCs. Our TPLs and our 7A lenders didn't ask for this as much because when they're looking at how to set life insurance requirements, they're going to follow their lending institutions' policies. But when we have our certified development companies, they've asked us, how can we know that we set the right level of insurance at application that then OCRM would agree to when they are coming out to reviewing our files that we ask for the sufficient amount? So Diana met with Susan Strike, who's the OCRM director. So before we provide this guidance today, know that this has been vetted by SLPC, it's been vetted by OFA, and by OCRM. So David, please go over the guidance with us.
Certainly. Everybody's favorite topic, life insurance, obviously an area of question in regards to the new SOP, because we now have instances where the SOP says life insurance is necessary. So if you have a project where life insurance is necessary, what does that mean? What do I have to do? So it's a two-pronged test. Number one, it's got to be consistent with the size and the term of a loan. A 2-year policy doesn't really fit for a 20-year debenture, things like that. And the second one is, well, how much? And how do I figure out exactly how much life insurance is necessary? Because we hear a lot from the CDC world and through them from the third-party lenders that they're looking for a consistency of outcome. They want to make sure that what they present to us and the analysis that they do ends up with the result that they're looking for, which is we accept what they presented and either issue a loan approval or whatever the issue at hand may be. So in that context and in discussion with headquarters and things, we've decided to look at this and say, okay, for a consistency of outcome, what's the best way to get there? And the best way to get there is to have a in essence, a math solution. How do we get to how much insurance is going to be required and the SLPC and the agency will accept? So let's go on to the next slide, and please don't fall out of your chair when you see the intensity of the information on this slide, and we're not going to go through each one of the pieces of it, but in essence, what we're looking for is you have the project costs. You know what the loan funds are going to be used. You may not have an appraisal up front, but you know what the loan funds are going to be used for. And you know how much the borrower is contributing to the project, you know how much the third-party lender share is, and you know how much SBA share is. So based on that, we can now do a math equation to come to what's the minimum amount of insurance that would be acceptable for the transaction. So we're using standard liquidation rates for looking at it. So commercial real estate, residential, land, equipment at 50%, leasehold improvements, furniture and fixtures at 5%. So we can apply those multipliers to your project cost, and that's what the calculation here is done. We've got the liquidation value of the building and the furniture and fixtures, et cetera. So we come to a total liquidation value. And then just a simple subtraction. We take the TPL's lien, the liquidation value minus the TPL's lien, and we get an amount, and we take a look at that in regards to what's the collateral shortfall in regards to the 504 debenture. And whatever that collateral shortfall is would be the acceptable amount of insurance for a project where insurance is necessary. And I know that there's a lot of information on the screen, but it's fairly simple. We're looking at liquidation values, and then we're going to subtract the third-party lender, see what, if any, is left over after we do those calculations, and then address the insurance requirement in those cases where it is necessary. We can now look at that number when it may be impractical or some other reason the insurance for the total amount of the debenture just isn't going to work. There may be a solution, and that solution would be generated through the math and through actually working through the calculations. That way, when we're looking at these, we're not doing an arbitrary assignment. We actually have numbers and facts and figures and a calculation that the CDCs can do, knowing that if they do the calculation and that's the amount of insurance that's presented to us, that the outcome can be certain that we're going to accept that as an insurance level that is appropriate for that specific transaction. So again, you should get a copy of this so you'll have this as a reference point. So moving on from that, if we can move the slide one more time. And SLPC sends out weekly tips to the CDC industry, and this is just accumulation of some of the things that we've seen. So we wanted to take just a second to go over a few of these things for the CDCs. This is what will be a refresher of what they've already seen in their inboxes. For the third-party lender world, these are some of the things that we've been notifying the CDCs on, just to make sure that these are part of their write-up and part of the documentation. Going back to the availability of liquid assets don't include sheltered retirement accounts, the 401ks and the IRAs and things like that. Those wouldn't be included in the availability of liquid assets. Life insurance, we just went over, decide who is necessary. Is this business dependent on a single individual owner? Without that person, the business would, for all intents and purposes, cease to exist. So make that determination. If it is, then make the appropriate life insurance recommendation to us. For businesses that have debt, please include a fully complete debt schedule. Very common that we don't see that. It makes an analysis of the application much more difficult if we don't have that information. And finally, be aware of dates. Make sure that the application and the information in it is that's date sensitive is within the required dates. We run into this sometimes if we have to screen out a file or ask for additional information, that some of those documents might have been right on the border. By the time we get the response in, maybe they've gone stale dated. So just be aware of that and make sure that the dates on the information that you're presented is still current at the time we actually get the full and complete file for processing. And with that, I will turn it back over to Linda. Thank you.
Thanks, David. We've got a couple of questions that have come in. One is the personal financial statement form expired 1/30/2018. SBA, if we have submitted our form for review by OMB, we're allowed to continue operating on that form until they've completed their review. So obviously that's something that we'll be issuing a new form once we get our OMB approval on. And we do have some requests for the weekly update, Hen. So if we have someone on the line that would like to be added to the weekly blast, who should they contact?
Well, they can send me their contact information, such as email address, and then we'll add it to the distribution list.
Sure. So if you've got the slide earlier on where we're introducing Hen, it is his first name dot last name at SBA.gov, and then he can add you to the list. Thanks, Ian. Now I'd like to introduce, Marvin, if we can move to the next slide, I'd like to introduce someone on our team who works very closely with the SLPC, and that's Babak Hustani. He handles our exceptions to policy, but he does so much more than that. He works with us in developing the SOP and in developing notices. He was very instrumental in the rollout of 504 debt refi, and he worked very closely with many of you when we were doing the franchise reviews. He's done a lot of technical assistance to CDCs and to TPLs around the country when you've run into an issue and you need to sort of deconstruct and reconstruct your project. He's done a tremendous job on all of those areas. And there's a couple of things that he's going to be doing on the quarterly calls, but for today's segment, he wanted to talk about common occurrences that he sees in exceptions. So, Baba?
Yeah, so some of the common occurrences that we actually get on the reconsiderations for exceptions to policy, the predominantly, majority of them have been in regards to extending the disbursement period for the SBA authorization. Now, if you have a regular 504 loan or a refi that's without an expansion, typically the SBA authorization on those is good for 48 months. However, if you have some sort of a exception that something happened or the property was in the hurricane zone and they couldn't finish construction, they need longer than 48 months, we can go up to 5 years on the SBA authorization, so for 60 months maximum. That is what it's basically called a 5-year money. So the exception would be, in this case, an additional 12 more months. Then the exceptions go to Sacramento with your supporting documentation of why the exception is necessary, and then Sacramento will go ahead and forward that over to headquarters, and it comes on my desk for review. Now, for the refi program without expansion, this is the new refi that came out last year, or a year and a half now. The SBA authorization on those is good for 6 months, but to be consistent with our appraisal that's good for a whole year, we are allowing an exception to policy to extend it by an additional 6 more months. So the SBA authorization is good for 6 months, but if you have a good reason, valid reason with supporting documentation, you send out your exception to policy to Sacramento and they forward it over to us. We review it for an additional or a maximum of 6 more months, that can, for a total of 12 months on those. Other occurrences that we've seen currently or more recently have been exceptions for the refi program for the waiver of the 50% rule. Those, for good cause reasons, we can actually waive them. Good cause would be that there's no other CDC within the territory where the borrower is in existence, or your CDC is the closest to this borrower. And then the second good cause reason would be that your CDC has an existing current loan with this borrower. So there's only two reasons that we can actually waive this 50% rule would be, one, the borrower has no access to any other CDC. Two, your borrower, you actually have an existing relationship or an existing loan, I should say, not an existing relationship, but an existing current loan with your borrower. The other exception to policy that we've seen currently is bridge financing or short-term financing. And just a reminder that if you do have a borrower that has an existing loan with a term of 3 years or less, or even around 3 years, if you submit the supporting documentation like the note, the hardship that this borrower is going through, then this would be considered a purchase, and you can actually submit this as an exception to policy. If it's slightly over 3 years, then it can come over to us. But if it's under 3 years, of course, that just goes to Sacramento, and Sacramento, we just review it like a regular application. That's all I have for exceptions to policy. Until next quarter, we'll figure out other stuff to add on to this. But thanks, Linda.
Okay. I'd like to, terrific job, both to you and to Ian and to David, terrific job, and to Sherry, who is not with us for the Q&A portion, but terrific job for them and for Diana. It's been a great call today. We've got a few questions that we have before we wrap it up. One of the questions that we have is regarding insurance. There may be times when obtaining life insurance is cost prohibitive. One of the things, too, that we would also ask that you see is there any life insurance that may already be available that could be assigned to SBA? Because it's not our goal to increase costs for the borrower, but we would definitely expect that if you were to come in with some type of exception of policy analysis, that you would do some sort of cost analysis and explain why it would be cost prohibitive, not just make the statement that it's cost prohibitive. We'd like to see rates or some research that's done or some extraordinary circumstance that would help make that case, and that's on a case-by-case basis. Can't make that give you a blanket answer, but you know, life is not cut and dried. You know, that we understand that there's special circumstances do exist, and that insurance can be expensive. So we would ask that the CDC make the case and let us consider it at the SOPC level, and then only if they can't address it, then they would come to headquarters. If a project has multiple or two partners that each own 50%, is it acceptable to suggest life insurance on the key operator manager and not require life insurance on the other, or would the SBA prefer the requirement be split and life insurance be required for both? So I'm going to ask David, because David did a presentation on life insurance, but certainly if he wants to deflect it to Diana and I, that's okay too. David, do you want to? What is your normal protocol?
Well, I think the first question that needs to be asked is the key operator manager, is this business solely dependent on him? And if it is, then my answer would be that would be the individual that you would want the life insurance on. But if you have a 50-50 partnership or 50-50 ownership and they're both in there, they're both managing, they're both running the day-to-day operations, then it's possible it's not dependent solely on one person. So
let me add just a bit of direction to what David provided, and that is what the SOP says. And that is, generally speaking, you know, David's right, we're looking to the key man, but the SOP says a single-member LLC or a sole proprietorship is the absolute situation where you really need to look at the requirement for life insurance, because there's no depth behind that. So to his point, you know, when you have two people who own, but one of them runs and one is a passive owner, it's clear that the absence of that individual, or it's presumed that the absence of that individual would be critical to the continued operation of the business, and that's what the sitter would consider as well.
Our next question, can you address the discrepancy between the guarantee of the spouse with respect to the 504 program versus the 7A program? The 504 program states that the spouse owning 5% or more to combine an ownership of 20%, whereas the 7A program indicates a spouse owning any interest together with spouse totals 20%. Just wondering if there's an intent to have separate requirements. So we'll take a look at that. It's not our intention.
Yeah, no, it would not be the intention. And you know that we changed the regulation this past year to enable SBA and or the CDC or lender to require anyone to guarantee a loan regardless of their ownership, depending upon its critical nature or relationship to the business. So we have always gone under the premise that the spouse's collective ownership is combined to determine how they're treated for the purposes of guarantee. So regardless of whether the spouse owns 2, 3, 4, 6, 10%, but if together with the owning spouse or the owner or partner in the business, they hit that trigger of 20%, we consider that together.
The next two questions I'm going to combine. Matt Schroeder may not have looked through the statute when it was released on refi, and Connolly is relatively new as an executive director, and Connolly would probably not have been at the helm of the CDC when the 50% rule for refi was rolled out. So let me just address a legislative issue that helped shape our policy in refinance. When the refi was introduced on the Hill, there was concern that there would be some CDCs that would just become refinance shopped, that it might be easier to find existing loans and refinance them as opposed to meeting the mission of what a CDC is to do, which is to go out and help start or expand small businesses and help with financing. And for that reason, it was the legislation that put the cap, the 50% cap, that a CDC cannot refinance for more than 50% of their prior year's activity. So it's not the concept that a CDC is forced to give up their potential deal to competition. You should really kind of reverse that statement and say, if a CDC wants to be engaged in refi actively, they need to get their regular volume up so then they could offer the refi product more actively. Because what the Hill's looking at is for the CDCs to be robust, not to have refi as their primary business.
And just to add on to what Linda mentioned, in terms of the 50% rule for the waiver, that could be found on SBA policy notice 501939. That's the refi without extension program. So again, the control number for that is 501939, where you can actually read more about it in terms of what Linda mentioned. But just a quick example as well would be, if your CDC in the prior year lent out $1 million in just regular 504 loans, then this year you're only allowed to lend out $500,000 in the refinance without expense. That's what that 50% rule actually basically means. But if you want further details on that, definitely you're welcome to shoot me an email. This is Babak, or you can also go over control number 501939. And
this isn't the only time that the Hill has put a restraint on activity. The Hill requires one job for every $65,000 that you loan. And so to have a cushion in your portfolio, you might have a jobs bank where you can offer more of the public policy projects because you're meeting that goal or you're in excess of that goal. So this is a very similar using a carrot that, that's the Hill's intention, that if you have loan volume, you're allowed to do more refi. So that's their incentive, to incentivize to do more of our regular loans, and that was similar to their carrot to have more job creation. So we should try to look at it in the positive of what they're allowing us to do as to seeing it as a restriction. So on the 327s, are 327s still required to change the operating company name? And I would say probably just as a follow-up to this, we need to recirculate the notice on unilateral action. I think that could address a lot of people's questions on this. So, Dinah, we probably have time for one more question. Which question would you like us to end on today? It looks like we have a lot more on the insurance question. So, let's see. Let's go with the restaurant question. So we'll end on the restaurant question. That we found that many larger restaurants with few locations have established management teams for over 5 years. So actually, if Dennis is on the call, this might be a Dennis-David combined question. So if the business has 100% owner, can the case be made for life insurance not being required given the management team? And the answer to that is no.
And the reason is this: is the management team going to take over and pay the loan when somebody dies? Are they going to continue? Do they have the legal authority to operate the business? Does the business not go to an estate and have to go through that process? Obviously, we're looking to make sure that if this business doesn't continue, and the fact that it has one single owner increases the risk that it won't continue as it is, that SBA's risk is mitigated, and that's the position that we would take on that.
I do have one question on the SOP and wet signatures. NATCO is in the process of putting out a technical issues memo. While we do understand that there are some scanned documents that we do accept while a loan is being processed, we have a list of required documents that do require a wet signature that the CDC must keep for their long-term archive. So when you're looking at what will we accept as a scan, think of it in your mind that we would accept it as a scan while you're processing the loan, to expedite it, to upload it, but we still require the wet signatures for the archive for the 1244, for the personal financial statement, for the 912s.
And we see a last question. Is the 50% rule for refinance based on approved dollars or funding? It's based on approved dollars, so it's based on the prior year approved dollars that you have done.
Well, we want to thank everyone for your participation on today's call. Certainly a very active and robust dialogue. We didn't even get a chance to open up the phone lines and do the town hall type questions. So hopefully more of that on next month's, the next quarter's call. And we thank you for joining the call today. Our time is up. We'll send the slides as a follow-up and be looking for that notice near the end of March.
And those of you who have questions up here, I believe we get a list of these questions. We'll follow up on the ones that didn't get answered directly, and we'll provide those back probably through, maybe we could do it in one of the weekly updates that the center provides. So we'll work on the rest of the things that we didn't get a chance to get to and get you some guidance on the specific questions through the center. So if you're not signed up with the center to get the weekly updates, you might want to go ahead and send Ian the email to do that. Thank you guys so much. We appreciate your CDC hard work, and we appreciate the third-party lender participants and everybody that supports the business, and we want to see a better next quarter. So we're in it with you. Thank you so much.
Thank you for joining today's conference. The session is now concluded, and you may disconnect.